So we're now going to be looking at stop management, and we're looking first of all at the 3-bar trailing stop management. The 3-bar trailing stop management is a very good way to reduce risk and lock in profits as the trades continue to move in your favour. It gives your trades a little bit of a chance to breathe and move while still locking in and reducing risk as it goes along. It's really important to allow your winning trades room to breathe, and that's one of the things that this stop loss management does very well. Now, you need to understand as well that when I say the 3-bar trailing stop loss, it's trailing underneath the lows of the bars if you're being a buyer, or it's trailing above the highs of the bars if you're being a seller. And on this chart in front of you, I've actually deliberately highlighted all of the different divergences, both continuation divergence and reversal divergence, from September through till the current time. What we're going to do is we're going to work through each of these, and we're going to highlight the entry levels and the stop loss levels, and we're also then going to move the stop loss along and show where the trades would have been stopped out for losses and also stopped out for profits all the way along through this chart. When we're looking at 3-bar trailing stop loss, we also need to understand that we put our stop loss several pips behind the high or the low of the bar. We actually put our stop loss 0.1% of price behind the high or the low of the bar. Now that sounds a lot more complex than it actually is. Essentially, we need to look at the prices first of all on the right hand side of this chart. And if we just take the one in the middle here, we can see it's 0.80160. Now, when we're taking 0.1% of price, essentially that should be a number that's very close to 10 pips. Now, rather than just using 10 pips, because different currency pairs are at different prices, we want to make sure we have a number that's related to that specific currency pair, hence we use a percentage. So on this particular currency pair, rather than being 10 pips, we take the first 2 digits of the price, not the 80, but the 0.8. So 0 and 8, the closest way we can get those to 10 is to say 8, so 8 pips. So our stop loss on the euro pound will be 8 pips behind the high or low of the bar, just to keep it safe. If we were to look at a different currency pair, for example the euro dollar, we can see we'd be using at 1.2 around 12 or 13 pips behind the highs and the lows of the bars. If we progress across the cable on the pound dollar, we'd be looking at around 16 pips behind the highs or the lows of the bars. So if we go back to the euro pound now, and we'll look at the divergences, identify them, and then we'll also go through and show where the trade is entered and the stop loss, and we'll move the stop loss as we progress all the way through. So to begin with, let's hide away some of this so we can't see what happens next. I'll skip through bar at a time so that we can identify exactly what is setting up. First of all, we can see the higher low that's illustrated here on the price action. Bullish pin bar to bullish pin bar, we can see this low to this potential higher low. Bearing in mind at this point in time, we don't know that this is going to be the higher low. However, we have a lower low in the stochastic. If we zoom in slightly, you can see the blue percent K has flipped to the upside. Therefore, we assume this is the swing low, and we look to buy on this particular bar. Now we're going to show the entry levels in blue, and we'll show the stop losses in red. Our entry level is going to be above the high of the bar, and our stop loss is going to be underneath the low of the bar. Remember, with the entries above the highs of the bars, we're going to give it a few extra pips, typically 2 or 3. So 2 or 3 extra pips on the daily charts here above the high of the bar for the entry. the stop loss is going to be 8 pips underneath the low of the bar. And the reason for this is because we have 0.79, well, 7.9 is very, very close to 8, so we're just going to call it 8 pips underneath the low there. And we just do that to keep the stop loss safe just from the stop hunters that are out there. Now we can see with the next day, the next bar, the trade has been triggered. Now our stop loss is underneath this bar to begin with because it is the lowest low of the last 3 bars. So the lowest low of the last 3 bars, that's the reason why the stop loss is in this position. Now that we've been triggered into the trade, this stop loss stays in the same place because this is still the lowest low of the last 3 bars. Bearing in mind we're placing our stop loss underneath the lows because we're buying. Another bar comes along and closes, and we're still going to leave our stop loss where it is because this is still the lowest low of the last 3 bars. If the next bar goes higher, then we'll be able to move our stop loss. And that's exactly what's happened. We're now able to move this stop loss from here to underneath this level here. 8 pips underneath this bar. The reason being, out of bar 1, 2 and 3, this is the lowest low of the last 3 bars, less 0.1% of price. Therefore the stop loss moves from here to here. As we progress, we have another buyer bar that's come forwards, but this is still the lowest low of the last 3 bars, therefore we do nothing. The lowest low of these 3 bars is here, this bar less the 8 pips. So the stop loss has moved once more, and we've now moved our stop loss to a position whereby we're in profit very slightly, even if we get stopped out. This first movement of the stop loss reduced our risk. Now moving it up to here, we've actually locked in a very small amount of profit. Nothing particularly to worry about profit-wise, it's hardly a huge profit. However, taking a small win is a lot better than taking any kind of loss. Please understand though, we don't want to break our rules just to seek small wins. So we have another bar that's come along. Our stop loss can now move again to underneath this bar here, because this is the lowest low of the last 3 bars. And the next bar comes along. The lowest low of the most recent 3 bars is in fact underneath here, and so therefore we've moved the stop loss again. You can see now from the original trade risk of around about 48 pips, we've now locked in around 48 to 50 pips. Therefore we've definitely made at least a 1-to-1 on our trade, and if the trade keeps moving in our favour, then we can lock in even more potential profit. The next bar comes along, and the lowest low of these 3 means to move the stop loss to just underneath this bar here. So we've now actually locked in slightly more profit, nothing to speak of, but a little bit extra. We're now sitting in profit of around about 64, less the 8 pips, so around about 56 pips of profit. Around about 56 pips of profit from an original risk of around about 48 pips. So we've made more than a 1-to-1 at this point in time. If we look clearly, we can see that the lows of these bars are pretty much the same level. Our stop loss is 8 pips underneath the bar, so the stop loss is actually around here. Our stop loss is here. We can see that now there's no point in moving the stop loss because it's already in the correct position. So the next bar comes along, we're still in the trade, we have not been stopped out yet. And the whole reason for this is because we've got our stop loss 8 pips underneath the lowest low of those 3 bars. This was 6 pips underneath, therefore we're still in the trade. So we're in the trade, we've locked in this many pips, we're happy that the trade's running in our favour, and our stop loss still stays in the same position, which is where this highest red line is. The lowest low of these 3 is underneath here. We've still got the stop loss at this position, so that's fine. It's not until this bar here comes along and closes up here that gives us a new stop loss movement. Bar 1, bar 2, bar 3. The lowest low of these 3 bars is indeed this one. Therefore, we can actually move the stop loss once more to underneath here. And again, remember this is 8 pips underneath this bar, just to keep it safe. If we'd have moved it right up underneath the low of the bar, we would have been stopped out here. By giving it that little bit extra breathing room, it allows price to wobble around a bit, and we can see that people are trying to hunt stops through here. By giving it those few extra pips, we've actually kept ourselves in the trade. And we're currently in a position where we've locked in a profit of around about 65, 70 pips. One, two, three. The lowest low of the last 3 bars is exactly where the stop loss already is, so there's no need to move it. We have another bar up here, therefore we can move the stop loss again, ever so slightly underneath this one. The lowest low of the last 3 bars is this bar here, less the 8 pips. 1, 2, 3. The lowest low of these 3 bars mean that we can move the stop loss underneath this bar here, less the 8 pips. Again, another bar comes along, the lowest low of these 3 bars means we can move it again. The lowest low of these 3 bars means that we can move it again underneath here. I think you'll find that's actually now a reversal divergence trade that's now setting up. Now what's happened here is we've got this first trade that's run through here with a 48 pip risk has run on to make something in the region of about 145 pips. So it's made, roughly speaking, 3 times what it actually risked. So that's a 3-to-1 trade there. And we'll just put a little note there so we know that this trade risked 1% and made 3% back again, and it ended in a 3-to-1 reward to risk trade. And we can see that this trade actually took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, before it then got stopped out. So 18 days, roughly speaking, we're looking at 1 calendar month there. But essentially, considering that we've only placed 1 trade and made 3% that month off that 1 trade, it's a very good position to be in, bearing in mind that there's other markets for us to look at as well. So we're happy with how that trade has moved. We moved the stop loss 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times over that period. But moving the stop loss takes about 2 or 3 minutes. So 2 or 3 minutes work is not a particularly huge amount of work every other day. And we can see there the fruition of what's happened is that we've made 3% return on that trade. Now, the 3-bar trailing stop keeps getting trailed and trailed and trailed, and we can see the result there. Now that we've seen this one get stopped out, let's look at this reversal divergence example that we've got illustrated with this arrow. We can see we've got a higher high in the price action and a slightly lower high on the stochastic. I'll zoom in so you can see it more clearly. We do have indeed a lower high on the stochastic. when this %K, this blue line, first flicked over, it was on this bar here. But we can see that in order for the reversal divergence trade to actually get triggered, one of the lows of the bars must get broken. That means this bar must go lower than this bar, and that does not happen. This bar must go lower than this bar, which again does not happen. This bar must go lower than this bar, which we can see has happened. Therefore, that's the reason why the arrow is here, to depict the trade entry. That means that throughout this period of time here, we'd have actually had ourselves an entry level at this point, underneath this first bar, then again, and then again, until we actually got triggered into the trade. Our stop loss is the highest high of the last 3 bars, which we can see clearly here, would be this bar here, plus the 8 pips. We're happy that we've been triggered into the trade, and now we start to run our 3-bar trailing stop until we get stopped out. We're in the trade, and we're still in the trade, and it's going heavily in our favour at this point in time. We can see that the highest high of the last 3 bars means the stop loss can get moved very slightly behind the high of this bar here. It was originally behind this one, but now it can move ever so slightly behind this bar here, plus the 8 pips. The highest high of these 3 bars means we can now move the stop loss again to this point here, plus the 8 pips. So we're reducing our risk at this point. Yes, the trade is in profit, but we are reducing our risk. We have not actually locked in any profit at this point in time. Now we have bar 1, bar 2, bar 3. The highest high of the last 3 bars is this one, so the stop loss can move down to that level. 8 pips above the high of this bar, which means we've actually now locked in a very small amount of profit on that trade. And we now see that the highest high of the most recent 3 bars means we can move the stop loss once more to 8 pips above this particular bar here, around this kind of a level. So we've now got our stop loss moved to 8 pips above the high of this bar here. We moved our stop loss once, twice, 3, 4 times so far. Our original trade risk was around 48 pips. We've locked in around 40. So we're just about coming up to the 1-to-1 reward to risk level on the trade. The trade is still running. The highest high of the last 3 bars is this one. We can't move our stop loss against us, so we leave it where it is. And this is the reason for putting the stop loss 8 pips above the high of the bar, just to keep it safe. Again, we leave the stop loss where it is. We're still going to leave it where it is because it's still the highest high of the last 3 bars. Now we have these 3 bars to look at. The highest high of these 3 mean that we can move the stop loss down to 8 pips above the high of this bar. Therefore, we've managed to lock in even more profit on this particular trade. The highest high of these 3 bars, we can again move our stop loss to behind this bar here, plus the 8 pips. Note that we're still in the trade. We have not been stopped out. We can't move our stop loss against us. This is just another example of why we use that 0.1% of price behind the high or the low of the bar. And remember that 0.1% of price is around about 10 pips. On this particular currency pair, it's 8 pips. On things like the pound dollar, it can be around about 15, 16 pips. But it's just the first 2 digits of the price, and it's the closest number to 10. So 0.8, of course, is 8 pips. The trade is still running in our favour, and still running in our favour. Now our stop loss is still at this level up here, but we note now that we actually have a buy signal from reversal divergence. That is, we have lower lows in the price action and a higher low on the stochastic. We can see the blue here and the blue just underneath here. Therefore, we have ourselves a higher low on the stochastic. The blue line has flicked up, and to make this more visible, I'm just going to change the thickness of the red line there so that you can indeed see the blue line is underneath the red. I'll change the thickness of them both. We can see the blue line is just underneath there. Therefore, we have a higher low on the stochastic. And with that higher low, we have a reversal divergence. Therefore, rather than just following blindly our 3-bar trailing stop, because we have a signal pointing to the upside, we would actually move our stop loss down to the entry level of the reversal divergence trade. Because we're looking to get long this market now with the reversal divergence, we don't want to still be short on the previous reversal divergence from up here. Because we now have a buy signal, the sell signal validation is coming to an end, so we move our stop loss to the entry level of this new trade, which you can see does actually get triggered in. And it's exactly the same thing here. We had the continuation divergence give us the trade, which ran into the reversal divergence and switched from being long to short. The reversal divergence here actually triggered the trade and ran to this next reversal divergence down here. This particular trade had a stop loss of around about 48 pips, 45 to 48 pips again, and the return was around 120. So again, we've got just about a 2.5 to 3 to 1 reward to risk on that particular trade. We'll mark it down as a 2.5 to 1 reward to risk. But again, a very nice reward to risk on that particular trade using that 3-bar trailing stop method. So we look at the buy signal now that we've generated. We're looking to buy here with our stop loss under the lowest low of the last 3 bars, less the 8 pips, which puts underneath this bar here, less the 8 pips. And of course we can see that this trade that was short through here got stopped out, and we're now into the long position. We can see that the last 3 bars, 1, 2, 3, the lowest low of the last 3 bars is this bar here. So we can move the stop loss very slightly to underneath that bar, less the 8 pips. Prices jump back up again, and we can see that the lowest low of the last 3 bars actually now falls under this one, very slightly higher, so you can see that we're reducing risk as the trade moves in our favour. The lowest low of these 3 bars is still exactly the same place, so there's no stop loss movement at this particular point in time. And now we have 1, 2, 3. The lowest low of these 3 bars means our stop loss gets moved 8 pips underneath here. Bring it down very slightly. We can see 7 pips, 8 pips underneath there. There we go. Move down very slightly. The next bar has come along, and the lowest low of these 3 bars means we're going to move the stop loss once more. And notice now that we're actually moving the stop loss to a position where, roughly speaking, the trade is now break even, meaning we can't lose anything if the trade gets stopped out. This is a very nice place to be. We actually have got a double inside bar that's formed here now, and the lowest low of these 3 bars is still where the stop loss is, around the break-even level. We are still in the trade. The lowest low of the last 3 bars is actually this bar here, but we're still in the trade because of those extra 8 pips underneath the low of the bar here. So we're still holding on to the position. Our stop loss is still in the same place at the break-even point. Our stop loss is still in the same place, and it's only now that we have this next bar come along that we can move the stop loss. 1, 2, 3. The lowest low of the last 3 bars means the stop loss can now be moved underneath this one, actually locking in a small amount of profit for us now on this trade. We now have another movement. 1, 2, 3. These 3 bars. The lowest low of those 3 bars is underneath here, less the 8 pips. So we've locked in slightly more profit. Our stop loss was around about 45 pips, and we've currently made around 50 pips. So we've locked in around about the 1-to-1 mark at that point in time. We can see that we're still not moving our stop loss because this bar remains the lowest low of the last 3 bars. And now that this bar here comes along, there's a very slight stop loss movement that we can make underneath this bar here. So slowly but surely, we're locking in additional profits. The next bar has come along, and the lowest low of these 3 bars is this one. So we move the stop loss 8 pips, or 0.1% of price, underneath that. Sure enough, price is still going in our favour, and we're locking in slightly more profit along the way. Now here we actually have this reversal divergence that's set up, which we can see through here. We can see the lower high on the stochastic, and we can see the higher high in the price action. That means now that we have that %K flipped to the downside, it's time to move our stop loss underneath that bar to lock in as much profit as possible, because if we're looking at a short trade now, rather than being long, we want to be out of the long trade and getting into the short trade, which means that we've locked in just over 100 pips, 105 pips there, from a risk of 45 pips. So we've made around about 2.35, 2.4% there again. So we'll just note that down. That's a 2.4 to 1 reward to risk trade, just shy of 2.5 to 1. But again, a very nice trade there. And we can see the success rate of these trades and how it's giving us the upward movement, the downward movement, the upward movement, and now the potential downward movements as well. So now that we've identified this sell signal, we moved our stop loss on this trade to the entry level of this short trade. We have placed our entry level 2 or 3 pips underneath the low of this bar, and our stop loss 8 pips above the high of this bar. And the reason why the stop loss is 8 pips above this bar here is because this is the highest high of the last 3 bars. And we have been triggered into that trade now. So this trade here has been stopped out, and this short trade is currently now running. We can see that this bar here still remains the highest high of the most recent 3 bars. And now that we have this bar, bar 1, bar 2, bar 3, we're able to move the stop loss down, reducing risk on around about a 50% level. So we've removed 50% of the risk from this trade. It turns out this is a very short-lived trade because we actually now have a continuation divergence that's formed on this particular bar here. But ignoring that momentarily, we can see, of course, the stop loss has moved down into a small profit. But we can see the lower low on the stochastic, the higher low in the price action, we have a continuation divergence. We're looking at the lows to buy. We can see this is definitely a low, this is definitely a low. The percent K blue line has flicked up and therefore given us the buy signal. Therefore, we would actually move this stop loss to 2 or 3 pips above this bar here, because we're looking to put this stop loss to the entry level of this new buy trade. That means that now we have an entry level to buy. Where this blue line is, and we have our stop loss underneath this low bar here, because this bar is indeed the lowest low of the last 3 bars, less the 8 pips. And we're now going to carry on with our 3 bar trailing stop to reduce the risk on the trade and potentially lock into profits as the trade progresses. We can see quite clearly the trade has been triggered. The stop loss, however, will stay in the same place because the lowest low of the most recent 3 bars is where the original stop loss is positioned. Now that we have this next bar up here, bar 1, 2 and 3, there's a small movement of the stop loss. Which we can see moves from here ever so slightly higher. And the next bar comes along, and the lowest low of the last 3 bars is this one, less 8 pips. So we're able to move our stop loss once more, therefore reducing the risk on this trade. And the next bar comes along, the lowest low of the last 3 bars is this one, less the 8 pips. Our stop loss is pretty much around the break-even level there. We can't lose anything if we get stopped out. We could potentially make some money. And the next bar comes along, 1, 2, 3. This is the lowest low of the last 3 bars. Again, a very small stop loss movement there to help us lock in a very small amount of profit. It's always nice to have a small winning trade over a break-even trade, just because it's psychologically rewarding, but also because of the fact that we're actually adding to our trading account or making some more money, which means our 1% risk, or our percentage risk, is greater on the next trade. And the next bar has come along, which presents us with the opportunity to move the stop loss underneath this bar here. This is the lowest low of the last 3 bars, less the 8 pips. The stop loss still stays in the same place. And the stop loss still stays in the same place. And we can see it's still holding this level here. We're not moving the stop loss yet. Still, we keep the stop loss in the same place, underneath this bar here. It's only now that we're able to move our stop loss from here to underneath this bar. The lowest low of the last 3 bars, less the 8 pips, puts a stop loss in that position there. So we actually held the same stop loss there for around about a week, but we were locking in our profit and waiting for the trade to continue to move in our favour. And the lowest low of the last 3 bars puts the stop loss up to here, where we're now in a position where we originally risked around about 50 pips, and we've locked in around about 82 pips. So just over 1.5 to 1. We've locked in about 1.6% so far, which has now unfortunately been stopped out. But we can note that it is a 1.6 to 1 reward to risk. Another winning trade, another positive reward to risk winning trade. And we can now see another opportunity that presents itself. We have a higher low on the price action, a lower low on the stochastic, and the stochastic blue line, the percent K, has indeed flicked to the upside on this bar, therefore giving us a buy signal, meaning that we will look to place our stop loss underneath the low bar, less the 8 pips, and we will look to place our entry level above this point here. And again, it's 2 or 3 pips for the entries, but 0.1% off the higher or the lower the bar for the stop loss. We can see that the trade is indeed triggered in, and bar 1, bar 2, bar 3, lowest low is now here, so we can move the stop loss ever so slightly, of course allowing for the 0.1% of price there. Again, another bar comes along, and the stop loss is allowed to be moved ever so slightly underneath this bar, because this is the lowest low of the last 3 bars. There's now a big move to the upside, which allows us to move the stop loss to a much better position underneath this bar here, because this is the lowest low of the last 3 bars, and we're now at a position where we're reducing risk significantly. It's still going to hold that same position. We're not going to move the stop loss now, because this is still the lowest low of the last 3 bars. And as this next bar then closes, we'll then look to move the stop loss underneath here to reduce the risk further. And that's where we are at the current day right now. So at the current point in time, we've about 150 pips up, 146 pips up on the trade, and the downside is around about 18 pips. So very small risk that's left on the trade, and the trade is currently 140, 150 pips in profit, and as we can continue to move the stop loss, we'll do so to lock in profits as it progresses in our favour. We can see, looking at this, there has been some very, very good trades that have taken place. The best one here being a 3-to-1 reward to risk, but every single trade being greater than a 1-to-1. And every single trade through this specific example has actually worked out as being profitable. Now, of course, there are still going to be losing trades along the way, but you can see how this rolling 3-bar stop loss actually, when coupled with divergence, allows you to significantly reduce your risk and lock in profits in a very safe and consistent manner. Just remember, you need to make sure you add on the 0.1% of price, around about 10 pips, onto the stop loss, just to keep it safe. If you like the look of this stop loss, spend some time looking at some of the trade entries that you've taken recently, and look at the 3-bar trading stop loss to see if it could have improved or in fact reduced your winners or your losers, and also your overall percentage profit on account.